Good morning, this is Dave Toth with an RJO MRT Technical Webcast update for the gold, silver, and copper markets, as well as the US dollar index for Friday, November 12th. Starting off here with a daily log scale chart of the gold market, you can see this month's continuation of the secular bull trend that we believe defines the 1325.5 low from November 3rd as the level the market needs to fail below to break the broader uptrend enough to warrant moving to a neutral sideline position. In essence, a failure below 1325 is required to cause longer-term traders to liquidate all bullish exposure and move to a neutral sideline position to avoid the depth unknowns of a larger degree correction or reversal lower. In this regard, we are strongly suspicious that the past few days' sell-off attempt is merely a corrective hiccup ahead of continued gains to new all-time highs above 1424. And in that regard, we are looking at the area from mid-October of former resistance around 1388 as new support that we believe should hold this market if it's still truly strong and worthy of continued bullish policy from these levels. Looking here at an intraday chart, in essence, we're acting on the premise that this recent short-term downtrend will end up being just a three-wave and thus bull market corrective sequence. But by virtue of overnight's break below the initial counter trend low of 1382, the market has defined yesterday's 1417.60 high as the level this market needs to recover above to confirm this sell-off attempt as a three-wave and thus bull market corrective sequence ahead of new highs. So we'll be watching very, very closely in the days and perhaps even hours ahead for any kind of short-term bullish divergence in momentum that will define whatever low is left in its wake. Currently 1377.30 as an objective low support and risk parameter from which we can rebase a broader bullish policy. Anyone who's been trading the metals markets in general, and especially over the past few weeks, understands the relatively tight inverse relationship between the metals and the US dollar index. And in this chart here, on a 4-hourly basis, we show in red an inverted US dollar index to show the positive correlation, again inverted, between the US dollar and the gold and silver markets. When gold and silver is rallying, the US dollar is typically has been selling off, or again in this inverted state they will act together to show the fairly positive correlation. This is going back for a number of weeks now. When the US dollar sells off, again, this is inverted. When the U.S. dollar sells off, you see gains in a pretty tight negative correlation in the gold and silver markets. So any trading in the days and weeks ahead in the metals markets, we also want to keep a very close eye on what the US dollar index is doing, and we'll cover that in a few moments after we finish up with the silver and gold markets, because there's some interesting potential bearish divergence in the US dollar index following the past week's rally. Looking here at the silver market, you can see the magnitude of the secular bull trend in silver as well. We have to be concerned about the prospect that this latest phase of the rally from the 2284 low from October 22nd might have completed a five-wave Elliott wave sequence dating all the way back to the July 28th low at 1732. But given the magnitude of the secular bull trend, we are advising traders to require proof of weakness below at least former resistance, new support from the general 25, the figure area, and specifically below the 2475 corrective low from November 4th to reaffirm or give greater odds to the prospect that the market has completed a five-wave sequence up. In lieu of such proof of weakness, and as with the gold market, we strongly suspect that this past few days setback attempt is merely corrective ahead of further gains. In that regard, looking at a 4-hourly chart here, we're anticipating a bullish divergence in short-term momentum from the area around the 50% retrace of the latest phase of the bull from 2393 up to 2934. That 50% retrace cutting across at 2650. From a very short-term perspective, the short-term trend is down, and it's going to require, we believe, strength above at least yesterday afternoon's 2775 minor corrective high to increase the odds that this sell-off attempt, this corrective sell-off attempt, has ended and that whatever low is left in its wake will be a sound and objective low and risk parameter from which to reposition or rebase a broader bullish count to eventual new highs above 29.34. In lieu of such short-term strength above 27.75, we don't want to underestimate the extent to which this market might be able to correct further down, but we'll be watching very closely for some bullish divergence in short-term momentum to define a low that'll create what we believe will be a very favorable risk-reward opportunity from the buy side. For the time being, shorter-term traders with tighter risk profiles are advised to maintain a neutral sideline position. Longer-term players remain advised to maintain a bullish position with weakness below 24.75 required to negate that call. And again, we'll be watchful for any bullish divergence in short-term momentum to rebase a bullish play from. Moving to the copper markets, on a long-term daily log scale basis shown here, you can see the magnitude of the broader bull trend, and significantly the area of former resistance, new support around 390 from the October 27th period that we would expect to hold as new support if the market is still truly strong up here and if this past couple of days setback is merely a broader bull market correction. And also on this larger degree scale, a failure below the 370.35 low from October 29th is required to break the broader bull trend and expose a larger degree correction lower. From a short-term perspective shown here, this sell-off and break overnight below the 394.15 corrective low from Wednesday confirms a bearish divergence in short-term momentum that we believe defines Thursday's high at 408.35 as the end of a 5-wave Elliott wave sequence from the 370.35 low. But again, given the magnitude of the secular bull trend, an area of former resistance, new support that has thus far played its role perfectly, and the 389.35 50% retracement area of this latest phase of the advance, we're strongly suspicious that the end or lower boundary to this bull market correction will come from this 390 area. But we need the market to confirm a bullish divergence in short-term momentum to lend more credence and objectivity to that low as a risk parameter from which to rebase a broader, any kind of bullish exposure for continuation of the broader bull trend. Longer-term traders remain advised to maintain a bullish policy with weakness below the 370.35 low from October 29th required to negate that call. Shorter-term traders who have moved to a neutral sideline position as a result of this failure below 394.15 are required to maintain that sideline position until the market confirms a bullish divergence in short-term momentum from which we can rebase a bullish play. Finally, moving to the US dollar index, we've been discussing the 78.27 high from October 27th as a pivotal high the market needs to break above to break this longer-term bear trend over the past number of months, and especially from the August 24th high at 83.56, because by doing so, the market may have defined that 75.63 low on November 4th as the end of a 5-wave Elliott wave sequence, exposing a larger degree correction or reversal higher. Thus far, and giving some relatively weak performance of late today, the market thus far has rejected the 38.2% retrace of that August through November sell-off at 78.57. However, at least the short to intermediate term trend is up, and it has defined that 75.63 high from last week as a pivotal level this market now is required to break to reinstate this broader bear trend in the U.S. dollar. Until or unless that level is broken, we are concerned that the market might be starting a larger degree correction or reversal higher. That said, moving to an intraday chart and pertinent to at least a short to intermediate term recovery in the metals markets, you can see the developing potential for a bearish divergence in momentum by virtue of yesterday's late and overnight's new highs above 78.27 that defined the 77.44 corrective low from early yesterday as the latest and tightest corrective low that, if the market fails below, will confirm this bearish divergence in momentum and expose at at least a steeper setback to the past week's recovery that has caused some setbacks in a number of the commodity sectors, and especially the metals. So if and when the market fails below 77.44, we'll be looking for at least a steeper retrace and quite possibly a resumption of the broader bear trend in the US dollar index. And if that unfolds, we're certainly odds are going to favor a recovery in the metals markets that we spoke of, and some bullish policies there. So we're keeping a close watch on this 77.44 level, and if and when the market US dollar index fails below that, we advise shorter term traders to move to a neutral sideline position, and longer term traders will look to see if the market confirms a three-wave corrective sequence back that would perpetuate a broader or a larger degree correction or reversal higher in the US dollar index. But if and when the market fails below 77.44, we just don't want to underestimate, especially given how weak the dollar's been most of this year, we don't want to underestimate the extent to which this market might set back or even resume the broader bear trend, and that would certainly be likely to be a positive for the metals markets. So please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.